Good to go.
Good to go. Excellent. All right. Hello, folks. It's always a pleasure to get back here into the ecosystem again. And I look forward to a very productive hour or so with Ronnie. Just give me a second. Let me just pull up the numbers here. Yes. Okay. So this is perhaps the last time in 2021 that we are doing this as we begin the countdown to the new year. And Ronnie has kindly agreed to give us 50 minutes. I mean, it's the busiest week for him this week. So and I think thank you so much, Ronnie, for making it this side of the new year. Obviously, we are happy to have you back again the next year whenever that happens. I'm Rajeev, managing partner at Orias Venture Partners, an early stage VC fund with 95 startups that we've invested in, 3 unicorns already and 3 more on the way. It's been a great year for the VC industry in India. We produced more unicorns in 2021 than any other country in the world, including the US and China, 45 actually, as it turns out. Welcome. I'm very excited to be doing this session with Ronald-Peter Stöeferle. I hope I didn't muck up the name, Ronnie. Let me know if I did.
Almost perfect.
Thank you. Thank you. Ronnie is the managing partner of Incrementum AG. Incrementum runs 5 funds across a gamut of assets from gold to Bitcoin. And they are the experts on managing assets with a view to hedge against inflation. A very valid topic for today, given that the 6.8 CPI print that came out the last week from the Fed and the 10-year yields stubbornly stuck at the 1.4, 1.5, kind of a bracket, essentially creating a negative 5% differential on bond yields at this point in time. Guten Tag, Ronnie. Willkommen in Indian. Wir freuen uns sehr, dich hier zu haben. Thank you so much. I just thought I'll try a little bit of my German.
Thank you very much.
So Ronnie started as an analyst at Vienna-based Erste Group and set up the commodity research division, primarily focused on oil and precious metals. In 2000, he produced his first report on In Gold We Trust. So this is like, it's a 2007. So it's been almost a 15, 16-year journey for this report. And it has sort of hit milestone after milestone. It now is in, it's now going to almost 2 million people across the world, and also Mandarin. So I'm told that people brush up on the Mandarin by reading this report. So Ronnie, you need to tell me a little bit more about that, right? So we talk about Ronnie's view on fiat currency debasement and inflation, commodities, and different ways to hedge, cryptocurrencies, and more. So I'm really looking forward to it. So I'm going to hand it over to him for about 20-25 minutes. So we're going to cut it short slightly as compared to normal folks. And after this, we'll move to the Q&A discussion. Please type in your questions on the chat. We'll definitely get to them. I look forward to a productive 50 minutes that we have left over. So Ronnie, over to you, if we can get started with the presentation.
Thank you very much. Thank you very much for the kind introduction. Thanks for having me. Can you see my slides already? No, probably not.
Not yet.
Not yet. There we go now.
Yes, we can.
Excellent. So, yeah, thank you very much for having me. Thank you very much for the kind introduction. We talked about India briefly before, and I'd love to go back to India soon again. I love the culture, I love the people, I love the food, and obviously it's the most important marketplace for gold. And gold is something that is very dear to my heart. I do publish this brick of a report. It's called In Gold We Trust for 15 years now. You can download it for free in German, in English, also in Mandarin. We shall be working on an Indian edition. I think that's a big project going forward, and therefore I would love to give you now a brief overview what we think is going on in markets, especially when it comes to gold, when it comes to inflation, to the macro view, and then I would say let's do a Q&A session for roughly 30 minutes. I'm currently here in Vienna, working from home because we're experiencing our 4th lockdown now in Austria. But we're getting used to it. I closed the door so my kids cannot rush in. And yeah, I would say let's get started. Just a very brief overview about Incrementum. We are based in Liechtenstein. We're 5 equity partners, so 5 people own this company. We're a boutique asset manager focusing on commodities, on gold, and also on cryptocurrencies. We do wealth management services for high net worth individuals. And just to give you a view about Liechtenstein, it's a country in the center of Europe, and the population, the total population, is 35,000 people. So I think when it comes to Indian standards, that's a very, very small village. In
We are
fact, it's
missing a few zeros there, Ronnie.
but it is probably one of the most stable jurisdictions from my point of view in Europe. It's one of the very few countries without any government debt. It's ruled by the Liechtenstein family, so it's a great place to do business, especially when it comes to financial services. Now let's talk about this monetary tipping point. Ladies and gentlemen, last year in December of 2020, I published a report called Inflation and the Boy Who Cried Wolf. Back then, inflation rate CPI in the US was at 1.1%. Now we're at almost 7%. Back then, everybody ridiculed us for our forecast that inflation will become a topic again. Now it is a topic. So people really are becoming concerned of inflation. Now, of course, the big question now is, why the hell didn't gold perform in this inflationary environment? And I will try to answer this question in the next couple of minutes. But first of all, perhaps a little bit of a top-down macro view. What you can see on this chart is the US CPI. And we know that Paul Volcker, back then at the end of the 1970s, his job was to kill inflation. And he succeeded by raising interest rates up to almost 20%. And then the so-called Great Moderation started. So we basically had 4 decades of continuously falling inflation rates. From our point of view, this era, those 4 decades of falling inflation, is over from now. From our point of view, we will settle and we have to get accustomed with higher inflation rates. Now, for people in India, inflation is definitely something that is quite common and quite normal to consider when it comes to investments. It is something normal when you talk to people from China, obviously, from Brazil, from Turkey. But in the Western world, we all became accustomed that inflation isn't a really big topic when it comes to allocating capital. So I think in the Western world, inflation will catch many investors on the wrong foot, and nobody is really prepared for allocating capital in a more inflationary environment. And of course, I mean, one major driver of this inflationary environment is money supply growth. From my point of view, I'm not only from Austria, but I also adhere to the Austrian School of Economics. It's first monetary inflation, then it's asset price inflation, and then only the third stage is price inflation. And quite contrary to Paul Volcker, whose job was to kill inflation, over the last couple of years, central bankers never became tired telling us that we need more inflation. We have to print more to create higher inflation. Now we've got it, and now they keep telling us, oh, it's only transitory. I wouldn't be sure about that, because as you can see on this chart, this shows M2, monetary aggregate M2, which has the highest correlation to inflation. And you can see here that last year M2 grew by 25% in the United States. Of course, it's coming down now due to the base effect, but it's still at higher levels than in the highly inflationary 1970s. So what we saw in this tipping point in 2020, the tipping point that was caused by the COVID crisis, is truly something that is exceptional, and it's even exceptional compared to the 1970s. Now people say, well, you know, we cannot get any higher inflation because the velocity of money is so low. And my point would be, well, we already have high inflation despite the fact that velocity is so low. And if you compare it to the 1930s, but also to the time after the Second World War, both of the times we had velocity at even lower rates, and both times the US had to resort to drastic measures by devaluing the US dollar versus gold in the 1930s. They devalued the dollar by almost 70%. And after the Second World War, they implemented massive financial repression with a yield curve control, basically pegging government debt yields and creating higher inflation numbers. So from my point of view, once this whole COVID crisis is over, and I really hope that in 1 year from now, we won't be talking about COVID anymore, but probably I would have said the same last year. Then the velocity of money will start stabilizing and will start rising again. And it will meet this flood of liquidity that was created over the last couple of months. Now, we know that monetary growth and debt growth are inflationary drivers, but there's also some further inflationary drivers. First of all, is what my colleagues at Nordea, they called it Opranomics. So this basically means that policies like MMT, modern monetary theory, like helicopter money, like universal basic income, before the COVID crisis, there were, I would say, topics that were only discussed in rather left-wing economist circles. Now they have become mainstream, and it's not a question of if, but rather a question of when they will be introduced. The second thing is we are moving from monetary dominance to fiscal dominance. So my take is we should listen less to what the central bankers are saying and more to politicians. I think that politicians learned during the COVID crisis that basically their job is to fine-tune the economic cycle via massive stimulus projects. I don't think that this is really the job of bureaucrats, of politicians, but I think that they will have a hard time giving up this renewed power that they're having. So I think we should listen much more to politicians and focus on the fiscal projects that they are implementing, and they've got a much more direct and a faster impact on the economy and on inflation numbers compared to central bank policy like quantitative easing. Quantitative easing didn't really affect inflation numbers. It was merely an asset swap that created asset price inflation, but it didn't have any impact on inflation numbers. Fiscal policy does have a much more direct impact. Another thing that my friend Russell Napier said, government credit guarantees. He said the crucial structural change here is that the governments are providing credit guarantees to the commercial banking system. And now we have across the world bank credit growing really strongly in a recession, which is absolutely unheard of. Just one example from the UK for first-time buyers, the UK government gave a credit guarantee of £600,000. So basically the risks are not on the balance sheet of the banks anymore. It's basically on the balance sheet of the government. And I think those credit guarantees are a thing that we will continuously see over the next couple of years. Another inflation driver is that it seems that many central bankers think that they have to not only to fine-tune the economy and financial markets, but also the labor market and the climate. If you listen to Christine Lagarde nowadays, it seems that, I mean, she sometimes sounds a bit like a Greenpeace activist. So I don't think that they actually got a new mandate officially, but I think they tried to diversify or perhaps even distract a bit from their original role, which is monetary policy, by focusing more on racial economic disparities, for example, and fighting climate change. We also have average inflation targeting as a new driver. So basically the reasoning is inflation numbers were too low over the last couple of years. Now we have some more leeway for inflation to overshoot. And this leeway is being used. And there's lots of inflationary drivers coming from the market itself. We all know what's going on with freight rates. We all know those supply disruptions. I'm very confident that the market will solve these problems. So I think in a couple of months, those factors won't be that important anymore. But for the time being, they are. And we've got one big client who owns a shipping company, and he says, well, actually for us, it's a perfect environment. And we don't really need to increase our capacities because we're just making lots of money at the moment. So I think this factor will become less of a factor, but we shouldn't expect it to be out of the market very quickly. And then another very important driver is probably the deglobalization and a Cold War 2.0. So I think we all know about this, and this is a picture that shows the last summit that took place between the United States and China in Alaska. And I think the symbolic character is quite telling. And we all know that those issues between China and the US, but also Russia and the US and the rest of the Western world are becoming larger and larger, and they will become a big factor driving inflation going forward. Now, what's the status quo of gold? Well, actually, as you can see on this table, it's not that bad. We shouldn't forget gold was up 18% in 2019 and 25% in 2020. Now, year to date, gold is down 6% in dollar terms. In euro terms, for example, gold is up this year. In Indian rupees, gold is down slightly since the beginning of the year, but it was up 21% in 2019 and 28% in 2020. So what I would like to show with this chart is we shouldn't be too greedy. Gold actually really did its job. We saw a stellar performance of gold in the year of 2019 and in the year of 2020. So from my point of view, gold is only taking a breather at the moment. Gold actually, the average annual gold price was making a new all-time high this year. So the environment, especially for the mining companies, is terrific. As you can see on this chart, negative real rates are the foundation of every bull market in gold. Now, if you say, well, the time for gold is over, then this would also imply that you expect that real rates will become positive. And as you can see on this chart, actually, if you believe that also due to the high debt levels, over the next couple of years, we will have negative real rates, then at least a small allocation in gold is advisable. While if you think that we will see real rates rising above 2.5%, then you can say goodbye to gold. Do I believe that we will see significantly higher and significantly positive real rates? No, I think this is impossible anymore because of the high debt levels. We also see some very interesting developments in physical markets. Those are the COMEX gold deliveries in thousands of ounces. So people don't want to hold future contracts anymore. They want the physical gold to be delivered. Very, very important from my point of view. We're also seeing central banks buying physical gold. India bought physical gold. Thailand, Saudi Arabia, Ireland, one of the few Euro countries buying physical gold recently. We saw Poland and Hungary buying physical gold. So central banks try to diversify out of the dollar by allocating capital in physical gold. And it's not only central banks, it's also US corporations. Palantir, founded by Peter Thiel, one of the probably best connected companies out there. Most of their clients are government agencies and the intelligence. They bought physical gold worth 50 million US dollars for their balance sheet because they want to be prepared for a future with more black swan events. I think that's quite telling. Now, what really moves the price of gold is the institutional demand. And as you can see on this chart here, ETFs tend to be very pro-cyclical. So we're seeing inflows in gold ETFs once the price of gold rises, and we're seeing outflows once the price of gold falls. But I think it's really crucial for the price of gold going forward that institutional players start buying gold again. And so far, we don't see it yet. And this is a chart from our Bitcoin chart book that we just published today. So this is really brand new. Here's the link to the chart book. It's really fascinating. And this shows the so-called stock to flow ratio, and basically the inflation rate of gold and of Bitcoin. So the inflation rate of gold at the moment is 1.7%. For Bitcoin, it's also 1.7%. But the fascinating thing about Bitcoin is this is getting harder and harder. So the stock to flow ratio is rising and the inflation rate is falling. So from 2024 to 2028, the inflation rate for Bitcoin will only be 0.9%. And ladies and gentlemen, from my point of view, it's all about relative scarcity. If you are in an environment where money supply grows by 25%, like we saw it last year, you want to have scarce assets. And this is what gold and Bitcoin are all about. Now, brief overview about mining. We also manage two funds that invest in mining companies. Well, the mining sector is dirt cheap at the moment, not only on a relative basis, but also compared to its own history. We talked to 180 gold mining companies this year in one-on-one meetings. I've never seen this industry in a more healthy position. Gold mining is more profitable than ever. You can see the free cash flow for the top 50 gold miners. We've never seen higher free cash flows in the mining space. So they don't need a gold price at 2,000 or 2,500. They are making significant amounts of free cash flow already. Miners are still in anti-bubble mode. And I think we should be coming to an end because I want to answer your question, of course. Now, what are the best inflation hedges? According to our studies, it's commodities and gold. Now, the big question is, why didn't gold move this year? I think that gold already discounted this high inflation last year by going up 25%. Now, ladies and gentlemen, the job of gold is not to make you rich. The job of gold is to preserve your purchasing power. If you want to make really high profits, invest in mining companies, invest in cryptocurrencies, invest, of course, in venture capital, definitely. But I think the job of gold is really to preserve your purchasing power. And by rising 25% last year, I think it did its job pretty well. Gold retains its value when other assets do not, so it is a portfolio stabilizer. During the 20% weakest weeks for the S&P 500, so when stocks really collapse, gold is up slightly, so it stabilizes your portfolio. Commodities, ladies and gentlemen, from my point of view, are in a new bull market. We have done extensive research on this topic. So we are very, very positive on the nickel space, on commodities, in base metals in general, copper, but also on energy, uranium, and especially crude oil. And this is probably one of the most exciting charts for technicians. So this is a big cup and handle formation. Now we're somewhere here, and I think that people now are extremely bearish on gold. While the market is only, $300 away from its all-time high. So if you say that this is a big consolidation pattern, then this is probably the handle formation, another consolidation within this uptrend. And from my point of view, we can go significantly higher over the next couple of years. Gold is very cheap in relative terms, ladies and gentlemen. If you compare the current price to the high in 1980 or in 2011, it's dirt cheap compared to monetary base, compared to M3, compared to US debt. And we should not forget that the US dollar was extremely strong recently. So this was, of course, a big headwind for gold. Our valuation target is $4,800 by 2030. That sounds like quite a lot, but you can see the reasoning for our model. And it's a very simple monetary model in our 2020 In Gold We Trust report. Now I'm already coming to a conclusion. From my point of view, ladies and gentlemen, higher inflation rates are not transitory. We should focus more on fiscal policies. I'm absolutely certain that real interest rates will remain negative for the next years to come. Mining stocks will have one of the most profitable years in history in 2021 and will continue to do so next year, but they cannot really diverge from the price of gold. So as long as the price of gold is consolidating, I think mining stocks will really have a hard time. And from my point of view, next year we will see new all-time highs in the price of gold. Now, thank you very much for your attention. This was quite a lot of information, I know, in a quite short time frame. I hope that you enjoyed this, and now I'm looking forward to your questions. Thank you very much.
Thank you so much, Ronnie. I think it was a very clear, concise, clear viewpoint on the fact that inflation was not transitory. So let's start off with that. So there seems to be an alternative school of thought. China is now slowing significantly. All those, the crises in their housing market notwithstanding, the credit impulse is slowing, right? Supply shocks have reduced the quantum of material available to public. You've got shipping lanes, you've got energy, prices that are increasing. That's also slowing. And, most of all structural drivers like technology that are moving towards more disinflationary trends, right? And the 10-year is stubbornly stuck at 1.45, which is supposed to be the biggest indicator of what is going to happen to future inflation. So why is it that you think that, inflation is not transitory when all these signs are sort of, there seems to be some kind of uncertainty around this, right? So how would you explain the deflation versus the inflation camp and why you're in the inflation camp given all these signals that you're seeing?
Well, actually, we wrote a book about this interplay between inflation and deflation. And let's not forget that the normal market environment would be deflationary. We all know that, in such a cell phone, the amount of computing power, all the services that we have on one cell phone nowadays, this is highly deflationary. So the technology that is so quickly evolving is deflationary, but within our monetary system where money is created as debt, we cannot accept deflation because now we are at this stage where monetary aggregates and the debt levels are basically in a exponential function. So those deflationary forces that we saw perhaps in 2020, for example, but also in 2007, 2008, I think we saw in 2020 that the will to to fight those deflationary forces is so strong that all taboos are being broken. So we saw in 2020, basically the Federal Reserve lowered interest rates to zero very, very quickly. They started buying corporate bonds. They introduced quantitative easing at significantly higher rates than they did in the previous quantitative easing. Massive fiscal stimulus was implemented. And I think it's really obvious. I mean, who would have expected this very quick spike that we saw in equity markets? So I think that to
Hey guys, can you hear Ronald?
yes, so I'm back. Sorry,
Ronnie, we lost you for about 10 seconds there.
Yes, I'm muted. I'm sorry about that. So I think that in 2007, 2008, the firefighters, they came to the party way too late, and they didn't really have the instruments. Now the firefighters, they're already waiting, and there's lots of cars and lots of instruments that they can use, and that they're willing to use once the fire starts burning. So I think compared to 2007, 2008, where basically nobody was prepared, now they, being the central banks, but also politicians, they are prepared. I think the big risk is just that they will use way too much water. And I think we saw that in this crisis, and we now see that inflation is really spiking up. I think it's interesting that politicians or central bankers still keep telling us, well, it's only transitory. But then on the other hand, Jay Powell just made this U-turn saying, well, perhaps it's not that transitory. And the interesting thing about this, and this already shows you the complexity of this interplay between inflation and deflation, the market at the moment doesn't really see inflation as a big concern. So if you have a look at commodity prices, if you have a look at the gold-silver ratio, if you have a look at the yield curve, if you have a look at the sectors relative to each other, I think the market is already discounting lower inflationary pressure for the next couple of months. And this is also our inflation signal is telling us the next couple of months, inflation rates will probably come down, but they will settle at a higher level. So I think we should get accustomed to an environment where we're basically always above the 2% inflation target. So this, I think, this new paradigm will be hard to grasp for many investors, because let's face it, in the Western world for 40 years we didn't really have inflation as a big concern. Now, if it happens, most investors will have no clue how to navigate in this new environment. And who was an active investor in the 1970s? I don't know too many fund managers that were already managing capital in the 1970s. So this will be a big surprise for many people.
So I get what you're saying. So you're essentially saying, look, it might not be 7%, it'll come down to maybe 4 or 5%.
Yes.
But
yes.
since the Fed or anybody else can't raise interest rates, you're still going to have that negative real rate that's happening. And that's always good for gold. So pile up on gold, you're not going to be sorry. That's effectively, I think, what you're saying in layman terms, right?
Yes. Rajeev, I wanted to emphasize, gold for me is not a religion. I think there's, hardcore gold bugs. For them, there's nothing else, just gold. We're asset managers. For us, gold should be a part of your portfolio, 5, 10, 15%. It really depends. But you also should invest, of course, in the human capabilities, in the human creativity, in entrepreneurship, by investing in equities, investing in companies. I think that commodities should have a place in your portfolio. I think perhaps real estate, but I'm not sure if it really makes sense to buy 10-year Greek bonds at 1%. I'm not sure if it really makes sense to buy a 100-year Austrian government bond at a yield of 1.2%, given the fact that we're in an environment where inflation is really a concern. Will the euro be around in 100 years? I'm really not so sure about it. But will gold be around in 100 years? I'm absolutely certain.
Absolutely. Let me switch to a topic which I think I've been wanting to ask. See, you come from a part of the world, kommen Sie Österreich. So obviously you're from the world that is most concerned about and most focused on ESG, most focused on climate change. You know, that's Europe really generally, right? So and ESG has been this thing that has sort of had both the upsides and the downsides. So ESG is now credited with the, I think, $85 crude that we saw in the recent past.
Yes.
You know, WTI, because of the fact that there was no you know, funding going into these, you know, all funds were sort of stopping you know, funding going into the energy prices. Now, what do you think is happening in ESG, and do you think that you know, it's currently being in the short term the enemy of growth? I mean, that's sort of how it is being portrayed across in some of the circles.
Well, to be honest, I'm very critical when it comes to not ESG in general, but how it is being used and implemented. From my point of view, it's lots of virtue signaling around. I think that if you talk to many asset allocators, if you talk to many bankers, for them, commodities per definition are something bad nowadays. But I mean, everything around us, you know, most of the stuff that we have also for our cell phones, of course, we need commodities. And most of the people that are so critical of, you know, fossil fuels and mining in general, they've never visited a mine. They've never been to a gold mine. They've never been to a copper mine. And I think, you know, we're investing in this space. We are writing about ESG in our In Gold We Trust report for 4 years now, and there's lots of positive things going on in the market. But I think that just focusing on ESG, this will probably harm our economies. It will slow our growth, and we are already seeing that energy prices are going through the roof. I tweeted it out for energy wholesale prices in Germany, which is of course a very important industrial player. Energy prices are going through the roof at the moment. So this will trickle down to consumer prices. It will trickle down to producer prices. So I think this whole focus just on ESG is perhaps a bit too much, and the other thing that I'm criticizing, it's only about the E, while the social and the governance aspect, from my point of view, are also very important. But everybody thinks that, you know, ESG means not investing in fossil fuels. That's totally wrong. You know, Rajeev, we've got, for example, one fund that invests in the uranium space. Now, most people don't have too much of a clue about energy markets, but I think with the whole Energiewende in Germany, so basically getting out of fossil fuels, out of electricity generation from coal mining, coal plants, I think for this transition period, we will need nuclear power. And in this space, I think the supply-demand picture is staggering. This uranium fund is almost up 100% year to date, and I think that people will really have to do more research on energy markets, and I think the decisions that many politicians did were very short-sighted. And at the end, the customers have to pay in the form of higher inflation rates. But this is also from a social point of view. Of course, for a billionaire, he doesn't really care if energy prices are higher or not. But for people having a hard time and having a hard time making ends meet, of course this is a huge factor. So this is really something that I'm criticizing. It is extremely unfair, and it's very short-sighted how ESG is being implemented at the moment.
Understood. So thank you for that, Ronnie. The other question that I was, you know, thinking about asking is basically, as a hedge against inflation, let us sort of look at a quick comparison between Bitcoin and gold. For most of the last 2-3 months, I think Bitcoin has been seen as a better hedge. And there was this suspicion in the markets that a lot of the money that was intended for gold was actually being diverted to Bitcoin. In some senses. So that's something that I think we have seen. Obviously, both of these, gold has held its own a little better in the last couple of weeks as compared to Bitcoin. Bitcoin is sort of, I think it's below the 50,000 now after a high of 66 or 67,000. So obviously, there's something happening there. Care to shed some light on how you see the interplay between these two? And I mean, the other question that I also had around this hedge against inflation was silver. Silver is one of those commodities that has sort of, it's gone crazy, right, Ronnie? There is no correlation between what's happening to the silver price and what's happening in the markets. At least gold is a little bit more, it's crazy, but it's within a short volatility rate. But silver is like, help us understand.
It's gold on steroids.
Yeah, absolutely. So what's happening here?
I think in the silver market, first of all, we're seeing lots of positive developments, especially when it comes to electrification and the whole green wave. It will impact the demand side, and we're also seeing positive signs from the supply side. But I think that silver is not really able to to rise without the price of gold rising. So I don't think that that silver will start outperforming gold unless we're really seeing a renaissance of gold. But of course, if you say that, well, I'm pretty confident regarding silver, regarding gold going forward, then you should have a close look at silver. Obviously, the volatility is much bigger. It's a smaller market, but I think it's very interesting. And in fact, we've got one fund that invests in gold, in silver, and in cryptocurrencies. Now, coming to your question regarding Bitcoin, I started getting interested in Bitcoin in 2012. My wife keeps telling me, why didn't you buy more Bitcoin back then, and why did you sell most of it after having a 10-bagger? I said, well, it's not that easy, but we've got two funds that actually combine gold and Bitcoin and cryptocurrencies in general, and I think this totally makes sense. Gold being, let's say money being a technology. It's nothing else. It's a technology for storing energy, for storing human energy, basically. Now, I think gold is doing this job pretty well for 5,000 years. Bitcoin is around for slightly more than 10 years. So of course, the volatility is higher. But I think what we saw last year, or let's say 2021, is that Bitcoin is really growing up. We are seeing that the marketplace is becoming much more efficient. We are seeing large players coming into this market, the big banks. We are seeing that the futures markets are established, that the options market is getting more liquid. When we started one of our funds, we were one of the largest players in the option market in Bitcoin. So now these markets are really they have really grown up, and I think that going forward, if you say, well, Bitcoin and cryptocurrencies, that's just a bubble, that would basically mean that you're saying that technology and digitization is a bubble and we'll go back to this old world. Now, of course, I don't know if Bitcoin will be around in 10 years or if there's better competitors coming up. I really don't know. But if Bitcoin will be around in 10 years, it will probably be at 1 million, perhaps, probably even higher. So I think we like gold for stability. We like Bitcoin for convexity. It is absolutely fascinating what's going on in the crypto space. So much creativity, so much good ideas, so many really ambitious people working on solutions. So therefore it really fascinates me. So in this environment, you want to hold a non-sovereign hedge against the monetary debasement, and in an environment of deeply negative real rates, I think it just makes sense to hold currencies or monies that cannot be inflated at will. And I think this relative scarcity that I described before, this is really what's central to understand gold, but also Bitcoin.
Great. So let's shift topics to something. Ronnie, you have this view that obviously as an inflation hedge, you're bullish on the base metals, you're bullish on energy. Crypto is fine, but let's look at these two cases. One of the most interesting things that's happened over the last few years is that China has now become the largest player in the world on commodities, right? So more than half of all the commodity demand actually goes to one country, and that's China right now, right? We wish we were there. 20, 30 years ago, we were the same size as China and something, darn those Chinese. That's the way I sort of look at it. But nevertheless, so they are now the number one player, and China's clearly slowing, right? With the household sector being such a powerful, the real estate is their edge. That's how the Chinese got wealthy, and that sector is now under serious stress. So don't you think that in the short run, at least in the next 1 year or so, you're going to have a huge pressure coming on these base metals and energy, because obviously China itself does not require it, and it's 50% of all demand of the country in the world right now?
That's a great question. Obviously, the signals coming out of China, they're disturbing. I mean, the Chinese property market, I think, is at least twice as big as the US property market. So the largest real estate developer basically going into bankruptcy is not the best sign. But on the other hand, we have to say that on a relative basis, the People's Bank of China was very, very hawkish, probably one of the most restrictive central banks. Now it seems they're opening up again. It's not only monetary policy, but also fiscal policy becoming looser now. Now, we saw that commodities were doing well in this environment where basically China was contracting. So I think this should at least have a positive impact now. Perhaps also it has to do with the Olympic Games coming up. But I think this is one driver. The second thing is that I think this bull market in commodities will primarily be driven from the supply side. So we should not forget that over this really brutal bear market that we saw in commodities, basically no capital was allocated into bringing new mines into production, into exploration. There's no human capital going into this space. For example, there was somebody tweeted out, he was Harvard Business School, and there's like 300 graduates from Harvard Business School, and there were some companies basically at a conference, and the companies presented themselves and they wanted to get the best graduates. And for ExxonMobil, for example, out of those 300 graduates from Harvard Business School, one guy went to the booth of ExxonMobil and said, well, I would consider working there. And I think this might be anecdotal evidence, but I think for the younger generation, nobody is studying geology anymore. Nobody is studying mining engineering, for example. So this is something that will have an impact on future production. And the second thing is, I think that this move to fiscal stimulus, of course, it does impact commodity demand. Of course, if there's a big infrastructure package in the US, if there's a Green New Deal in the European Union, of course it does affect commodity prices very directly. And as I've said, supply is really a concern in many markets, like copper, like nickel, for example. But we also see, and this basically ties back to the question before regarding ESG, that for energy markets and for fossil fuels, there's enormous pressure being put on oil companies, for example. So from my point of view, this is a very, very let's say interesting setup. So we see oil prices next year going above $100 per barrel. I think that this commodity super cycle that has started last year is a super cycle that basically nobody is invested in. we talk to many institutional players, and they all say, well, commodities now, this has already gone too far. Nobody is really invested in commodities at the moment. And perhaps we'll take a breather, definitely. We have already taken a breather, for example, in copper, but it's consolidating very well. But I think this bull market is just getting started.
Fantastic. And I think, Ronnie, we have just come to the end of time. I normally end with what assets would you say the portfolio has to be about? If you can just take a moment to answer that, then I think we can close it. Or if you're in a hard stop, then we'll close it right now. So over to you.
Well, you know, first of all, I have to leave. I've got a big appointment now. But thank you very much for having me. I hope you enjoyed this. We can send you or provide the slide deck. Have a look at our webpage, incrementum.li. All our publications are available for free. All information about our funds is there. Drop me an email. Follow me on Twitter. And if you should come to Vienna or to Liechtenstein, let me know, and I'll gladly invite you for drinks or for dinner. And the next time I'll be in India, I will let you know.
Absolutely. We looking forward to have you back in India again, Ronnie. So definitely that, and have a great holiday, that's coming up, and best of luck. So look forward to next such conversation. Thank you so much for really
Thank you very
insightful
much.
conversation and spending the
All the
time on the
best.
busiest week of your year. Cheers.
Thank you.
Bye-bye.
All the best. Take care.
Thank you.
Merry Christmas. Bye-bye. Thank you.